The year 2025 began with a seismic shift in the global trade landscape. On February 1st, President Trump, in a move that sent shockwaves through international markets, announced a sweeping 10% tariff on all goods imported from China. This unilateral decision, effective February 4th, marked a significant escalation of the simmering trade tensions between the world's two largest economies. The tariffs, according to the White House, were a response to concerns over illicit fentanyl imports and alleged currency manipulation by Beijing. This move effectively tore up the fragile trade truce established earlier and signaled a return to the confrontational approach that defined much of Trump's trade policy. The business community reacted with a mix of apprehension and resignation. Many American companies, heavily reliant on Chinese manufacturing and supply chains, found themselves caught in the crossfire. The tariffs, they feared, would translate into higher costs for consumers and businesses alike, potentially dampening economic growth. The administration, however, remained steadfast, arguing that the tariffs were necessary to protect American jobs and intellectual property from what it perceived as unfair Chinese trade practices. China wasted no time in responding to what it viewed as an act of economic aggression. Within days, Beijing announced retaliatory tariffs on a range of American goods targeting key exports like coal, liquefied natural gas, crude oil, agricultural machinery, and automobiles. The tariffs, ranging from 10 to 15%, were carefully calibrated to inflict maximum pain on sectors seen as crucial to Trump's political base, particularly in the American heartland. The swift and targeted retaliation underscored the high stakes involved in the escalating trade war. China, determined to project an image of strength and resolve, signaled its willingness to engage in a protracted economic conflict with the United States. The move also highlighted the delicate balancing act facing Beijing: retaliate forcefully enough to deter further American aggression, but not so forcefully as to trigger a full-blown trade war that could damage its own economy. The impact of the escalating trade war was felt most acutely in sectors where the two countries are deeply intertwined. The electric vehicle industry, a sector already grappling with supply chain bottlenecks and soaring raw material costs, found itself particularly vulnerable. Many American EV manufacturers, heavily reliant on Chinese batteries and components, faced the unwelcome prospect of higher production costs and potential supply disruptions. The tariffs threatened to derail the nascent EV revolution, jeopardizing jobs and hindering the transition to a cleaner transportation future. The semiconductor industry, the backbone of the digital economy, also found itself in the crosshairs of the trade war. Tariffs on these crucial components, used in everything from smartphones and laptops to advanced military hardware, threatened to ripple through the global tech industry. Consumers could see higher prices for their favorite gadgets, while businesses faced delays and increased costs for the chips essential to their operations. The trade war, many feared, could stifle innovation and slow the pace of technological progress. The trade war forced businesses on both sides of the Pacific to confront the vulnerabilities of globalized supply chains. For years, American companies had taken advantage of China's low-cost manufacturing prowess, shifting production overseas in search of higher profits. The tariffs, however, upended this calculus, forcing companies to re-evaluate their sourcing strategies. Some explored relocating production back to the United States or to other countries, but the process proved costly and complex. Retail giants, accustomed to sourcing goods from around the world to offer consumers the lowest possible prices, found themselves caught in the crossfire. Walmart, the world's largest retailer, warned of potential price hikes, a move that could disproportionately impact lower-income households. The tariffs, they argued, would ultimately harm American consumers, undermining the very people the administration claimed to be protecting. Section 5. The stagflation spectre, when prices soar and growth stalls. As the trade war intensified, market analysts grew increasingly concerned about the potential for stagflation, a toxic combination of stagnant economic growth and soaring inflation. The tariffs, they warned, would fuel inflationary pressures by raising the cost of imported goods. At the same time, the uncertainty generated by the trade war could dampen business investment and consumer spending, leading to slower economic growth. The spectre of stagflation, a phenomenon not seen since the 1970s, sent shivers through financial markets. Investors, spooked by the prospect of a prolonged period of economic malaise, began to pull back from riskier assets, sending stock markets tumbling. The trade war, once a distant rumble, was now a clear and present danger to the global economy. The escalating trade war between the United States and China sent shockwaves through the global trading system. The World Trade Organization, the international body tasked with regulating global trade, found itself caught in the middle of the dispute. China, arguing that the American tariffs violated WTO rules, filed a formal complaint with the organization. The WTO, already weakened by years of political infighting and facing accusations of ineffectiveness, struggled to assert its authority. Other countries, caught between the two economic titans, watched the escalating trade war with growing unease. Some, like Japan and South Korea, found themselves facing pressure from the United States to reduce their trade surpluses with America. Others, like those in Southeast Asia, worried about the impact of the trade war on their own export-dependent economies. While China met the American tariffs with retaliatory measures of its own, it also held a powerful card up its sleeve: strategic minerals. China is the world's dominant processor of rare earth elements, crucial components in everything from smartphones and electric vehicles to wind turbines and fighter jets. The potential for China to restrict exports of these vital materials loomed large, sending shivers down the spines of industries reliant on their steady supply. This potential weaponization of rare earths underscored the asymmetric nature of the trade war. While the United States held significant economic leverage over China, Beijing had carefully cultivated its dominance in critical supply chains, giving it a powerful tool to wield in response to American pressure. The potential disruption to global supply chains sent a stark message. This trade war could have far-reaching consequences, extending far beyond the realm of tariffs and trade balances. As the trade war raged on, a thick fog of uncertainty descended upon the global economy. Businesses facing unpredictable policy shifts and the constant threat of new tariffs delayed investments and put expansion plans on hold. Consumers, bombarded with news of rising prices and potential shortages, tightened their belts and braced for the worst. The trade war, once a distant threat, was now a palpable reality, casting a long shadow over the global economic outlook. The uncertainty extended beyond the economic realm. The trade war, fueled by nationalist rhetoric and accusations of unfair practices, strained diplomatic relations between the two superpowers. The risk of miscalculation and escalation loomed large, raising concerns about a new Cold War, this time fought not on battlefields, but in the arena of global trade. The U.S. China trade war, far from a short-lived skirmish, had morphed into a protracted and unpredictable conflict. Both sides, locked in a high-stakes game of chess, seemed determined to stand their ground, even as the global economy teetered on the brink. The United States, under the Trump administration, doubled down on its protectionist stance, threatening further tariffs on sectors like semiconductors, pharmaceuticals, and medical devices. China, for its part, signaled its willingness to endure short-term pain for long-term gain. It continued to diversify its trading partners, reduce its reliance on the US dollar, and invest heavily in domestic innovation, aiming to lessen its dependence on American technology and markets. The world watched with bated breath, wondering who would blink first in this dangerous game of economic chicken. The stakes were high, the outcome uncertain, and the potential for collateral damage immense.